A worker sits in the bright, fluorescently lit finance office of a local car dealership. They are staring at a piece of paper that guarantees their financial ruin, but they are going to sign it anyway. They do not want to be here. Their current vehicle, a 7-year-old commuter sedan, just suffered a catastrophic transmission failure. The repair costs $4,000. The worker does not have $4,000 in liquid cash. They are forced to trade the vehicle in for a new one, simply to maintain their ability to drive to work. But the math is a trap. The worker still owes $12,000 on the old loan. The dealership assesses the broken sedan and offers exactly $6,000 for the trade. That leaves a $6,000 gap. It is called negative equity. The dealer smiles, taps a calculator, and explains that it is not a problem. They will simply take that dead $6,000 debt and roll it directly into the loan for the new vehicle. To make the monthly payment look affordable, the dealer stretches the financing out to a 96-month contract, 8 full years. The worker signs the paper. They drive off the lot in a $40,000 SUV, but they owe $46,000 on the loan before the tires even touch the public asphalt. They are actively paying compound interest on a ghost. They are financing a vehicle that no longer exists, and they have bolted that dead debt to a new vehicle that is losing value by the second. And if they miss 2 payments, the lender does not send a tow truck. The lender presses a button, and the vehicle's software bricks the engine in the driveway. This is the negative equity engine. It is the mechanism the financial sector built to mask the absolute unaffordability of modern transportation, and it is quietly destroying the North American middle class from the inside out. $1.69 trillion in outstanding auto loan debt in the United States, $166.8 billion in Canada. Subprime delinquency just hit a 32-year high. And the affordable car, the $20,000 commuter sedan that used to be the entry point for working people, has been deliberately killed. The eradication of the commuter car. To understand how the system backed the consumer into this corner, you must look at the exact cost of entry. A decade ago, a working-class family purchased a reliable entry-level vehicle for under $20,000. The Honda Fit, the Toyota Yaris, the Ford Fiesta, the Chevrolet Sonic. Today, every single one of those models has been permanently discontinued in North America. The automakers did not kill the affordable sedan because consumer demand vanished. They killed the sedan because the corporate profit margins are exponentially higher on luxury sport utility vehicles and oversized pickup trucks. They explicitly removed the bottom rung of the transportation ladder. By February 2026, the average transaction price for a new vehicle in the United States hit $49,353. In Canada, the average new vehicle price soared to $63,665. The cheapest new vehicle you can buy in Canada right now is roughly $22,000. One option. 1. Everything else starts at $25,000 and climbs from there. The system effectively mandated that basic participation in the modern economy now requires the purchase of a luxury asset. The consumer did not get richer, the product simply became mandatory, and the oligopoly set a new, merciless price floor. I showed you this exact mechanism in the oligopoly tax. When a small number of producers control the market, they do not compete on price. They compete on extraction. The death of the affordable car is not a market failure. It is the market working exactly as the oligopoly designed it. The 8-year illusion. When the average vehicle price surpasses $50,000, the average median income cannot mathematically support a standard 4-year loan. The monthly payment would trigger immediate mass defaults. To hide this reality, the financial sector manipulated the only variable they control: time. If the consumer cannot afford the principal, the bank simply stretches the amortization schedule to create the illusion of affordability. In the United States, loans of 84 months or longer now account for 22.9% of all new financed vehicle purchases. The average monthly payment sits at $773, but Canada is the ultimate proof of concept. A staggering 57% of all new vehicle loans in Canada carry a term of 84 months or longer. Major Canadian banks now routinely offer 96-month car loans as standard practice, 8 years of debt attached to an asset that rapidly degrades the moment it is driven in the rain. The math is entirely toxic. A vehicle depreciates the fastest during its first 3 years of life, but an 8-year loan amortizes the principal incredibly slowly. The borrower is paying mostly interest in the early years, while the physical asset sheds its market value. This guarantees that the loan balance will always remain higher than the actual cash value of the vehicle for the vast majority of the contract. The financial sector deliberately engineered a timeline where the middle class is permanently trapped underwater. You are not building equity. You are renting a depreciating asset from the banking sector at 7% interest. The long-term auto loan is not a product designed to help you afford a car. It is a product designed to keep you permanently indebted to one. Tell me in the comments, What is the current length of your auto loan, and what is the exact monthly payment? The negative equity engine. When you combine a $50,000 price tag with an 8-year loan, you create the negative equity engine, and the engine is running at historic capacity. According to Edmunds, data from late 2025, 29.3% of all new vehicle trade-ins in the United States carried negative equity. Nearly 1 in 3 buyers owed more on their old car than it was worth. The average underwater balance hit an all-time record of $7,214. 27% of those underwater buyers carried over $10,000 in dead debt. In Canada, roughly 25% of trade-ins carry negative equity, averaging $7,700. Dealerships routinely report consumers attempting to roll $15,000 to $50,000 of negative equity into a single transaction. This is how the system extracts generational wealth. The borrower trades in the car in year 5 because it requires expensive maintenance. They roll $7,000 of negative equity into a new 84-month loan. 5 years later, they repeat the cycle, this time rolling $12,000 of compounded negative equity into the next vehicle. Among borrowers who rolled negative equity into a new purchase, 40.7% chose 84-month terms. The debt snowballs, while the physical asset completely resets. I showed you this exact mechanism in the subscription trap. The system does not want you to own anything. By forcing the consumer to endlessly roll negative equity forward, the banking sector has successfully converted physical car ownership into a permanent, lifelong rental subscription. You are renting depreciating plastic and steel from the bank at compound interest forever. The negative equity engine does not break down, it accelerates. The K-shaped collapse. The stress is not evenly distributed. It is concentrated, violently, in the borrowers who are already the most vulnerable. In January of 2026, the share of American subprime borrowers at least 60 days behind on their auto loans hit 6.9%. That is the highest level in 32 years of tracking, a record that stretches back to 1994. The deepest subprime segments show even worse numbers. Nearly 19% of some cohorts are 30 or more days delinquent. In Canada, the crisis is demographic. Borrowers under 36 now carry average non-mortgage debt of over $14,000. Their 90-day plus delinquency rate surged nearly 20% year over year. Auto loan delinquency for the 26 to 35 age group hit 1.45%, far above the national average. The young are drowning first. The industry calls it a K-shaped recovery. Prime borrowers, the ones with high incomes and strong credit, are performing fine. Their delinquency rates are stable. They buy the $50,000 SUV with a 60-month loan and pay it off without stress. Everyone else is collapsing. The subprime borrower, the near-prime borrower, the young worker who stretched into a vehicle they needed to get to the job that barely covers the payment. The system is splitting into 2 economies, one that can afford to drive and one that is being financially destroyed by the requirement to do so. I showed you the vanishing worker, how the labor market hides its real damage behind aggregate numbers. The auto loan market does the same thing. The average delinquency rate looks manageable, but underneath the average, an entire class of borrowers is being eroded into permanent financial distress. The digital repo man. The financial sector knows that loaning someone $60,000 to buy a $40,000 asset is incredibly risky, but they do not hold the risk. They sell it. Wall Street actively bundles these auto loans into asset-backed securities and sells them to global investors. In 2024 alone, the market issued $148 billion in automobile asset-backed securities. The mechanism is identical to the mortgage-backed securities that collapsed the economy in 2008, except this time the collateral is not a house. It is a depreciating machine parked in your driveway. But as the subprime delinquency rate surged to a 32-year high, the servicers required a new mechanism to protect the bonds. They needed a way to enforce the debt without the physical cost of hiring a tow truck. Enter the starter interrupt device. The industry quietly installs digital kill switches into the dashboards of high-risk financed vehicles. These devices allow the lender to track the car via GPS and remotely disable the engine the moment a payment is missed. This is not a theoretical technology. It is an active weapon. The Consumer Financial Protection Bureau recently filed a federal lawsuit against a major subprime auto loan servicer for the aggressive misuse of these systems. The government alleges the servicer incorrectly disabled vehicles at least 7,500 times and triggered warning alarms over 71,000 times when borrowers were not even in default. You do not own the vehicle, the bank owns the code. And if you stumble on your 84-month timeline, the bank does not send a warning letter. The bank sends a digital signal, and your car dies in your driveway. The car is not a vehicle, it is a leash, and the lender holds the other end. The Canadian theft tax. Canada has a unique layer of extraction that does not exist in the American market. It is the auto theft crisis. and it functions as a corrosive private tax on every driver in the country. In 2025, exactly 46,999 vehicles were stolen across Canada. Organized international crime rings target suburban driveways, steal the vehicles, and export them in shipping containers directly through the Port of Montreal. The national recovery rate sits at a dismal 59%. In Ontario, only 51% are recovered. In Quebec, 48%. Vehicle finance fraud at Canadian ports surged 72% year over year. The Port of Montreal alone saw a 63% increase in detected fraud cases. The police cannot stop the flow. The federal government will not secure the ports. So the financial burden of the stolen inventory is passed directly to the working class. Canadian auto insurance claims reached $900 million in 2025. To cover the hemorrhage, premiums spiked. Auto insurance rose 18.9% between 2020 and 2025, more than triple the national rate of inflation. In Ontario, the comprehensive coverage claims ratio previously hit 190%, meaning insurers paid nearly $2 for every single dollar they collected. Premiums are projected to rise another 4 to 6% in 2026. The Canadian driver is trapped in an inescapable triangle. They are financing a depreciating asset over 8 years. They are paying compound interest on thousands of dollars of negative equity, and they are paying extortion-level insurance premiums to subsidize an international crime syndicate that the state refuses to dismantle. If your insurance premium jumped at your last renewal, drop the number in the comments. I want to see the real cost of this drain across the country. The North American working class is trapped by its own geography. I showed you in the geography trap how the vast majority of our cities and suburbs were explicitly designed to require an automobile for basic survival. You cannot buy groceries without a car. You cannot access medical care without a car. You cannot get to your job to earn the wage that services the loan on the car that brought you there. The automotive industry and the financial sector understand this structural captivity perfectly. They know you have absolutely no choice but to participate. So they killed the affordable vehicle. They pushed the average transaction price past $50,000. They normalized the 8-year loan. They weaponized negative equity into a compounding engine that never stops running. They securitized the debt and sold it to bond markets. They installed digital kill switches to enforce compliance. And in Canada, they let an international crime ring steal the inventory while the consumer pays the insurance bill. The era of the paid-off, reliable commuter car is dead. The system has transformed human mobility into a highly leveraged financial product. The physical car is irrelevant. The compounding debt is the actual product. I showed you the oligopoly tax, how concentrated markets extract from captive consumers. I showed you the subscription trap, how the economy is converting ownership into permanent rental. I showed you the geography trap, how the physical layout of the country forces dependency on systems you cannot escape. This is the chapter that connects all three. The car is not a purchase. It is a permanent extraction point bolted to 4 wheels. And every mile you drive deposits equity into a ledger that does not belong to you. You're not driving to work to earn a living. You are driving to work to service the negative equity of the car that brought you there. Drop a like so more working families see the math before they sign an 8-year contract. Subscribe for the economic truths nobody else will say out loud. Tell me in the comments, how much do you spend every month just to get to work? Payment, insurance, gas, maintenance? Give me the total, not the estimate. The math. I am Hoch, and I will see you in the next one.